Let's take a few minutes to talk about the statement of cash flows, what has been for us the fourth primary financial statement that's been a little bit forgotten. We discussed it up front in the course, and then we pretty much neglected it up until this point. And it really is a very important financial statement. It's going to tell us where a company is getting its cash and where it's spending its cash. So overall, it will explain that cash balance. It's going to tell us, like I said, where a company is getting its cash. So how are they funding their business operations? Are they borrowing a bunch of money to finance their business operations, or are they generating it every day in their regular business activities? Are they paying out dividend payments, meaning are they making money? Do they have enough to pay back stockholders? Are they still borrowing more and more money, or are they starting to pay back some of those loans? Also, do they have enough cash on hand to pay their upcoming debts as they mature? So this, again, is giving us a lot of really good information pertaining to the health of a business. So when we talk about cash, we're not just talking about paper cash. We're talking about also short-term, highly liquid investments, things like short-term treasury notes, maybe 90 days or less maturity, something that can be readily converted into cash. So either it's so near maturity that its market value will be unaffected by interest rate changes, or it actually is cash. Now, if you remember way back to the beginning of the course, the statement of cash flows has three sections. It has an operating activity section, an investing activity section, and a financing activity section. So let's look at each one of those in a little bit more detail. Operating activities are the everyday business and revenue generating activities that a business is involved in. So the ways they would receive inflows of cash would be receipts from customers for services or merchandise provided, any cash dividends they receive on investments they have on other companies, or interest paid to them from loans they've given to other people. Outflows of cash are going to be any of their expense generating activities like salaries and wages, utilities, payments to suppliers for merchandise or product or supplies, taxes and fines, interest they're paying on loans to other people that they have outstanding. Investing activities, if you remember, deal with our long-term plant assets or long-term assets, so things like property, plant, and equipment. So how would you get an inflow from property, plant, and equipment? Well, you'd have to sell some long-term asset that you own in order to get an inflow of cash, or sell an equity investment. That equity stands for stock in another company. Or maybe someone is finally paying us back on a loan that we have outstanding with them, the principal amount. Outflows of cash would be to go for purchases. So if we have to go out and buy a new truck, that's going to be an outflow of cash, or buy a new building or equipment. Or we're buying stock in another company, or buying debt investments like bonds in another company. Financing activities relate to where we're getting our money from outside sources. So it really is going to apply to our investors and our lenders. So how would we get an inflow of cash from financing activities? Well, we could issue some stock, we could issue some bonds or notes, or we could actually issue some short or long-term liabilities. So we could go to the bank and get a loan. Outflows of cash will come from when we actually go back to pay out our dividends. If we're going to be purchasing treasury stock, that's when we go out and we buy our stock in our own company, or we're repaying back some of those loans. Or it says dividends here, paying owners' withdrawals. Withdrawals would apply to sole proprietors and partnerships. And I like this slide a lot because I think it breaks up for you in a very clear terms which are your operating cash flows, which are your investing, and which are your financing. So you can see up here, if we put a balance sheet together, we have our assets on the left side, liabilities and equity would fall on the right side. So if we look at current assets and current liabilities up at the top here in blue, those relate to operating cash flows. Long-term assets will relate to our investing cash flows, and then long-term liabilities and stockholders' equity relate to financing cash flows. So again, if you can kind of visualize that, that may help you a little bit. Now we also have things called non-cash investing and financing. Now those aren't going to go on the statement of cash flows because they don't deal with cash. The only thing that goes on our statement of cash flows are items that specifically deal with cash. So if we did have one of these items occur, we would put a separate disclosure to the notes of the financial statements. For example, we retired debt, but we didn't pay cash. We issued stock in its place. Or we converted preferred stock to common stock. We had, or we leased assets in a capital lease transaction. So we're not actually buying it, we're just leasing it. So here's the basic format of the statement of cash flows. Again, remember, we always start with our header, company name. This is the statement of cash flows, and this is for a period ended. So the cash flows from operating activities. Then we list out cash flows from investing activities and cash flows from financing activities. We will list the individual inflows and outflows of cash for each of those three activities. And then if we get net cash provided, that means more inflows than outflows, we will list that. Or if we have net cash used, which is more outflows than inflows, we will list that. And then the balances for each of those items. So we'll add up all the inflows, subtract all the outflows, and see what we get. Then we'll add those three together, and that'll give us a net increase or decrease in cash. Add that to our beginning balance at the beginning of the period. So we'd have to refer back up here to our header to see when the beginning of the period was. That would be the ending balance of the previous period. And that will now give us the balance at the end of our period. So I like this example a lot. I've got three companies here, three competing companies. And you can see they all have the same net increase or decrease in cash. And I like to ask students, if you could be either one of these three companies, BMX, ATV, or Trex, which company do you think you would want to be? So maybe pause the slide or take a couple of seconds to review this information and pick one in your mind and kind of justify why you picked the one you do. Well, I often get students who will say Trex. And let's look at this here real quickly. So they had a minus 24,000 in operating activities. This means in their everyday business activities, they overspent $24,000 more than they brought in. That's usually not a very good thing. Also, they had to sell some assets here in order to generate $26,000 of investing activities. And then they had to issue new debt. So they had to go out and get some new loans for $13,000 in order to generate cash. So this Trex here is really hurting financially. Just by looking at this statement, you can see they're not making money in their everyday business activities. They've had to sell some assets to raise cash, and they had to go out and get another loan. Let's contrast that with BMX here. Well, they made $90,000 from their operating activities. They bought some new assets, so they're investing in the long-term potential of their business, and they repaid some debt, $27,000. So BMX, even though they only had a net increase in cash of $15,000, they're doing a really good job of using the monies that they earned in their everyday business activities to generate hopefully more sales going forward. And ATV somewhere in the middle here. They're making money. They bought some new assets. They didn't take out or repay any debt. So hopefully that gives you a good indicator of why this statement is so important and what you can see from it so quickly. And there are two acceptable methods for calculating the operating activities section of our statement of cash flows: the direct method or the indirect method. So the statement of cash flows will be compiled either using one of those two methods. And again, those two methods only apply to the operating activities section. The investing and financing activities section will be the same regardless of which method we use. And the actual outcome, the final numbers, will be the same as well. So we'll talk about here in a couple of other videos them in more detail and why people may choose one over the other.